Hi everyone, welcome to the Money Space 101, where we make investing and finances in general simple, fun, and accessible for everyday people like you and me. If you're new here, I'm Angelina Senoge with a background in finance, and today we're talking about one of the most confusing questions for beginners. When do you actually buy shares? And when do you actually sell them? Let's break it down in a way that finally makes sense, and I'll be doing this in 4 sections. Section 1 is understanding what you're buying. Before you even think about buying or selling, you need to understand something very important. A share is ownership. When you buy a share, you're not buying a quick win. You're not getting into a get rich quick scheme. So, this is very important for you to note. You are buying a piece of a company, its profits, its future, and its risks. You don't need to know everything about the company, but you do need to know why you're buying it. Section 2, when to buy shares. I'm going to give you 4 pointers for this one. First point is buy when the company is financially healthy. So you need to look for signs like growing revenue, increasing profits, strong leadership, a clear business model, and a positive long-term outlook. And I mean, right now, at least we live in a time where we can easily just search for something on Google, even going on ChatGPT and just asking, okay, how has this company been performing over the past 10 years, over the past 5 years? And that generally just gives you an idea if whether this company is a good buy or it is not a good buy. And you can also rely on things like, or what are the Wall Street analysts saying about this company as well? What are other people in the financial space saying about this particular company? So that's when then you will know, okay, this is actually maybe like a good company for me to buy. And one thing that I always say in my investing master classes is when you're buying a company share, also look at the industry that it's in. So for instance, if this company is in the mining industry and you're looking at the South African mining industry forecast, how is it doing? Where will it go in the next 5 years' time? Where will it go in the next 10 years' time? Is this an industry that's going to grow further? Because remember, when you are investing into company shares, you are investing because you see the long-term value of this particular asset that you're buying. You're not just looking at its current value, but you're also looking at its future value as well. And then, for instance, maybe this company is in the technology sector. Oh, where's technology right now? Is it growing? Is it going to grow further? And I mean, right now, talking about AI and stuff like that, surely companies that are in the technology space are even going to grow further because we can see technology is currently moving so fast and it's also moving at relatively really good returns as well. So these are things that you need to look at. Look at the company, how it's performing individually, itself, internally, and look at external factors. And external factors is the industry that it is in as well. You don't need to be an analyst. That's one thing for sure. Most platforms, they show all this information. And I mean, right now, as I was explaining, you saw what I was basically showing you as to the profits, the revenues, the earnings per share, the market caps, and all those things. You can literally find all that financial information on certain platforms. And I, for instance, use BrokStock app, and BrokStock app generally just has all that information on the same app. So it just makes it easy for beginner investors, and you don't actually feel like, oh my goodness, I have no idea what to look for or where to look for it. Or you don't even have to go to the company's website to download the financial information. You can just have it at the tip of the app where you can do everything on it. Second pointer is buy during dips, not hype. Most beginners, they make the mistake of buying a stock when it's already trending on social media. Like, let's take, for instance, maybe we're talking about, let me just go out of the stock market and just go to the cryptocurrency, right? Bitcoin. There was a point where Bitcoin was like over 1 million. And now, when it's at that point, you're not now going to want to enter the market, whereas this asset, it's currently at its peak. So you entering the market at that time, it's actually quite risky. Rather wait for it to slightly go down a bit and then buy it at the dip, so that by the time that it goes up, that you go up with it. So this is when you should buy. One, you should buy when the company is fundamentally strong, and you should buy when the price has pulled back, as I said, not very high or at its highest peak, and also buy when the market is panicking for short-term reasons. And just to explain this, or give you an example, let's say, for instance, during the time of COVID-19. With COVID-19, the only thing that was actually in operations was essentials. So your retail stores and all those things, those were the things that were generally like still in operation. But things such as like oil companies, maybe for instance, your Sasol, they were not really operating because there was no movement, right? Which means their profits, they had also declined since people were not pouring fuel as they did before. People were not flying over and stuff like that. So, which means even airplanes and all those things that didn't need diesel as much. So, obviously, during that time, companies that were affected by the lockdown period, they were not doing well. But this was actually perfect for people that are potential investors or people that are beginner investors to get into the market. And by the time that the lockdown levels were just starting to get better, now we're going to level 4, to level 3, level 2, level 1, and then now there's just no more COVID and stuff like that. Then the companies are now just rising. So if you had invested back then in 2020, right now you would have sitting on so many returns, because at that time the share prices were very low. Because whenever anything happens in the economy, political space, or whatsoever, trust me, it is going to affect the investment markets. And depending on which industry that is in, it's either going to be a positive effect or it's either going to be a negative effect. This is called buying value, not vibes. Pointer number 3, buy when you have a long-term plan. If you need the money in 2 months, in 3 months' time, in a month's time, tomorrow, the stock market is not your friend. Stay away from it. Buy when you're investing for at least 3 years, 5 years, 10 years, or even above, because this reduces your risk and increases your returns. I'm just going to show you an example with this particular ETF, right? So an ETF is a basket that has specific shares inside. And generally, when you invest into an ETF, you are investing into the collective performance of all these companies together in one basket. So this is just one of the greatest ways of actually diversifying your portfolio as a beginner investor. And generally for beginner investors, since you don't really know which company to actually buy, so starting with buying things such as ETFs gives you an idea of how the market actually works. And then as time goes, then you have the confidence to start buying individual stocks. So take for instance this particular ETF, the triple Q. Just see how it's been performing over the past year, past 3 years, and past 5 years. Just look at that massive difference. So if you just waited 2 years more after 3 years, you would have gained so much profit that's even way over above 500%. So this then shows you that the longer you hold out, the longer that you are investing, the more compound interest will be in your favor, and the more the risk also smooths out in the long term. So don't do it, I'm investing now and I want to be getting something on a monthly basis. No, it doesn't work like that. Investing in the stock market, investing in ETFs, it is definitely for the long run. Pointer number 4, buy consistently, not emotionally. So what I always say as well in my investment master classes is that the easiest strategy for beginners is that you should follow the rand cost averaging, which you can call dollar cost averaging. And this is where you would be investing consistent amounts each and every single month. And this will actually help you in removing emotions. Right. So now you're not now going to be, oh, I'm not buying because I'm scared. I don't know when to enter into the market. You actually invest consistently each and every single month. It does remove that fear. It does remove that you holding back and actually missing out on what's happening in the market and be like, oh my goodness, I should have done this. I should have done that. So I'll tell yourself that you're going to start investing, and when you do it consistently. Even if it's 200 Rand per month, even if it's 500 Rand per month, it is something. It might seem little right now, but in the long term, compound interest will show you that your decision was the best. Section 3, when to sell shares. For this one, I'm going to give you 5 pointers. The first pointer is sell when your original reason for buying is no longer true. So if you bought the stock or the company share because it was growing, but 2 years later, the company is like declining, there's like a lot of things happening in that company, then it's probably time for you to exit. Because you need to ask yourself this question: if I didn't own this stock today or this company share today, would I buy it? And if the answer is no, it might be time to sell. Pointer number 2, which is very important. I need you to focus for this one. So you need to sell when the company is failing, not when it's dipping. I'm going to say it again. Sell when the company is failing, not when it's dipping. There's a difference. So the important difference between the two is that a dip is temporary, but a decline is a long-term failure. So let's say, for instance, like going back to the COVID-19 example, for instance, Sasol went all the way from 300 and something in their share price, And then in March 2020, their lowest was like around 25 rand per share. So this happening, definitely it did dip, right? This was a dip, and this is why it didn't go down because Sasso all of a sudden it's performing very poorly and all of those things, or there's a lot of internal issues, but it is because of external things, and external things which were beyond its control. So going back to COVID-19, there was no movement, people not going anywhere, people not using fuel, oil, and their services as much. But then if you were during that time like, okay, the world's not ending, at some point things are going to get better, so you as an investor, you need to be like, okay, I see what's currently happening, but 5 years from now, this company will start improving in its share price because then its current dip, it's being controlled by what's happening in the economy. So that's why then it's very important to know, is this a dip or is this a decline? A decline is when there's just a lot of things happening. So for instance, the profits are dropping for years and years on, management keeps changing, competitors are beating them as well, the business model just no longer works. So this is when there's a decline, and you should probably sell that particular company share. But when it's just a dip, no, don't stress. Just wait until whatever the external issue might be happening around that certain company to blow out. And then by the time that has blown out, then you will see there will start being an improvement in the company share price. So it's very important to note that, guys, the share price doesn't move like this or always like this. No, it's gonna be like this, and that's why it's for the long term. And you'll see when you do it for the long term, at some point over the long term it'll start becoming better, and then it goes up. But then if you invest for the short term, it's like this, and that's why there's more risk in the short term. But for the long term, it starts smoothing out. That's why we say invest for the long term, not for the short term. Pointer number three, sell when you hit your goal. So if, for instance, you bought those company shares and you're like, I'm going to sell them when I get 20% profits or when I get 50% profits, then that might be time for you to sell. Because I think also one of the mistakes that beginner investors also make is that we turn to let emotions get ahead of us. And I feel like there's not even a beginner investor mistake. Honestly, every investor does fall to that mistake. I mean, we've heard of people that invest to Forex and they just lost their money. It's not because they got the strategy wrong, but because they let greed get ahead of them. Just because something worked with this particular company share in terms of its returns, it doesn't mean that it's going to repeat itself with this particular share price or this particular share that you are investing in right now. So it's very important to have set goals and stick by them. So if you're like, okay, I'm going to sell when I get to 20% profits, then you need to sell. That way, then you do not let greed to get ahead of you. The fourth pointer is sell to rebalance your portfolio. So sometimes one company share or stock, it grows too much and becomes too large. I mean, I'm just making an example with Nvidia, for instance, a company that has to do with AI and stuff like that. I actually invest in it. Yes, Nvidia. I mean, if you have attended my investment master classes, you know that I talk about it like a lot. Yeah. So with Nvidia, if you had bought it, for instance, in this particular year, like 5 years ago, surely if you buy something and it goes over 1,000% in returns, why would you still want to keep it? Why wouldn't you want to sell it? Why would you want to, okay, let me just wait for 5,000% increase? Like, that is greed. You know, sometimes we don't actually realize things are greed because maybe it feels so bad when someone says it, like, yo, you're so greedy and stuff like that. But it actually is greed, because if you have bought something at this certain price and then now it is over a certain percentage, which is actually a record high for the particular company, it's actually a good time for you to actually sell, because you might find that you don't sell and then the company starts dipping, because now when it's reached its very highest peak, there's going to be sort of like an asset bubble where now there is too many investors, and then it's going to start going down a little bit. So then you would have lost out on those bit of profits. So it's better for you just to sell when you get at your peak, and whether you use your money for yourself or just reuse it to invest into other assets. So selling such a stock or company share will help you reduce risk, keep your balance, and protect your gains. The fifth pointer is sell if you need the money responsibly. I don't really recommend this, but things happen. We understand that. So You can't really be ignorant of that fact. If you need the money urgently, then it is generally is better for you to sell the shares rather than you taking out a high interest loan. But I need to put a disclaimer on this. I do not recommend this. This should be like the last resort. Your first resort should be your emergency fund. You should have an emergency fund. And this is what I always stretch out to beginner investors. It's very important that as much as you do want to start investing, but start building blocks around your investment journey. And one of those important blocks that you need to build is building an emergency fund. That way, you know, if something surprising happens, you're not going to make your investment account your first resort when you are going through that crisis, right? Because the moment that you're dipping into this particular investment account, you are literally disturbing the entire flow of compound interest. Compound interest won't be able to do its full work, right? So let time do its work. Let time do its work. Let compound interest do its work, and rather have an emergency fund. I highly recommend that. Start building your emergency fund today, right? And make it a consistent bill. Like, you know, for instance, 5% of my salary is going to go towards my emergency fund, right? The same way you're going to do towards your investment account. 10% of my salary is going to go towards my investments. And when you do that, you are treating these important things, which actually fall under paying yourself first, as a bill. You know, it's just like how we buy electricity. It's a bill. You know you need to do it. Whether you like it or not, you're going to do it. We pay rent. Whether you like it or not, you're going to pay the rent. So even with your investments, even with your emergency fund, even with your savings, treat them like a necessary bill. Don't treat them like, oh, I'm going to do it when I have some money left over. Treat it like your life depends on it, because it does. Your future does depend on such things. Final section, section 4, what not to do. Don't sell because the price drops. Right? Don't buy because everyone else is buying that thing. Do your research, find out, is this a good buy? Do I want to venture into this investment? What are my goals around it? Have some knowledge on it. Yes, fine, you won't know everything to do with that particular investment, but know something. Number 3, don't panic sell. This is actually like one of the most common beginner investment mistakes. Don't invest money you need next month. Don't check your shares every day. Listen, shares, ETFs, those things, they are long term investments. So, you checking it each and every single day, you are just going to be harboring fear or, oh my goodness, what's happening? Buying and selling should be logical, not emotional. And that's it. When to buy and sell shares explained simply. If you want a platform that makes investing simple and gives you access to local and global shares and ETFs, then definitely do check out BrokStock app, which I did mention earlier on, and that is the app that I use. And what I love about is the fact that it literally has everything in one. I mean, you saw, guys, like there's literally like the financial information of the companies on one app. You can see the news, you can find investment insights, you can find investment tips, you can find dividends and when they're going to be paid out. And this is just generally information that is very crucial and important for you as an investor, as a beginner investor. And if you understand what these things mean, you can just easily click there, for instance, and you'll find out what does that mean, what does it mean to you, and why you should basically care. And it'll just help you in making the right decisions. In the description box of this video, you'll find a link which you can use to download the platform. And because I am partnering with the BrokStock app, then you'll basically just receive a little money gift from me as soon as you deposit your account. And if you have any questions with regards to navigating the app or any investment questions that you have, then you can send us a DM at the Money Space 101 on Instagram, or at TikTok at the Money Space 101, or on Facebook at the Money Space 101. And do make sure to follow us just to see more of our content on a weekly basis with regards to our reels, our stories, and posts, just to keep you further engaged and growing in your financial journey. Bye. See you on the flip side of wealth. And do let us know in the comment section if you have any other questions, and I will get right to it.